The original theory was based, I don't know if you've ever come across a guy called Elliott wave theory. Well, I'll start with that. It's in the 1930s. He basically formulated a theory that mass investors faced with various types of scenarios in the market always repeat the same type of patterns in their behavior. It's a classic sort of faced with a loss, investors always cut their positions at the same time. Faced with an opportunity to make money, everybody piles at the same time. And this idea of crowd psychology, he sort of manifests itself into a very eloquent theory. And he said the market goes up in a series of 5 waves, of which 3 are up and 2 are corrective. Now, I'll come on to this in a minute. There's 2 absolutely key words here: impulsive and corrective. And there's one, and this is absolutely endemic to making sure that you analyze that you're actually trading on the right side of the dominant trends in the market, and that you spend a lot of time making sure, no matter which trading scale you're trading at, that you try and get on the right side of the dominant trend. And you can see it in that particular chart there, and you can see it in all the other ones. Now, his theory basically said the market goes up in 5 waves. 1, 2, 3, 4, 5. These 2 are counter trend, they're corrective. But don't confuse these in the first part of this with a top in the market. These are just temporary holding phases, consolidation phases before the main trend reasserts itself. And then the market comes down in a series of 3 ways. And the psychology behind this was basically from a sort of base level down here, you get the first wave of buyers who come in, okay? They get up to a certain level, doesn't have to be anything in anything particular. Let's assume they make 10%. Good, all these, that works. Let's try another one. Green's good. So let's assume that we go up like 10%. And everybody thinks, well, you know what, that's quite a lot of money. So they start to take some profits, okay? And then all the guys down here who thought, we really do like this stock. They think, well, let's buy some as well.
So this number is 2 impulsive or corrective then at that point?
Sorry?
Corrective, isn't it? 2?
This is corrective, yes. This is,
yeah.
If you like, this is profit taking. This is profit taking for all the guys who bought it down here originally, okay? I'm just trying to visualize this from a psychology perspective, from what all these investors out there are trying to do. Yeah. Because this will really set the pace of the direction. It's very important that you work out that you're trading. The impulsive waves are the ones that you want to be trading with. The corrective ones, yes, you can trade corrective patterns, but the idea is this is the trend, this is counter trend. And it's the idea, no matter what scale you're trading at, that you just got to be sort of aware that, is the dominant influence here, are the buyers in charge, if you like, are the sellers in charge? In terms of the equilibrium, is it shifting in favor of, sorry?
Is there any reason why? Is there any reason why there tends to be 3 impulsive?
No, this was actually based on his empirical. There is a reason, and I'm just getting to that here. There is a reason there's 5 waves. Because in the first wave, he said, well, the initial investors come in, they take some profit. So if you like, have a profit-taking phase. He said the next thing is that all these guys, they think, it comes down a certain way, and there's a number of key levels. Let's just say that it came down at 50%. Then all the guys who bought it here originally say, do you know what? It's now come down a lot. Let's start buying it some more. By the same time, all the guys who missed this originally, they say, hang on, why don't we buy it as well?
So the volume goes up at that point?
It's often associated with an increase in volume, but the point is, the market then starts to go up twice as fast. Okay. And generally, the relationship between the waves, so this one, the third wave, and this is the killer wave, the third wave, is the one where you've got the maximum impulsive tendency. You've got the most buyers, more investors trying to get involved in it. It's, from a risk management perspective, it is the one you do not want to be on the wrong side of. If you're short and you think there's a situation where we might be going into this super super impulsive phase, that's when you're not just going to lose some money, you can lose an awful lot of money very, very quickly. And so that's the basic thing up there. Up here he says, well, do you know what? We get up here, you know, we see the bulk of all these guys, the bulk of the profit taking comes in here. There's always some Johnny-come-latelys, the guys who've missed the entire move. So they come in at the last thing, having missed all the move up here. They've missed most of it. They always come in, they always say in our business, this is the retail buyers. This is where the man in the street gets involved. This is where, you know, it's actually reached fever pitch, if you like, in the press that you must own this stuff. All the institutions are out. The last bit is effectively, you know, often on lower volume, but obviously, you know, the main buying interest is exhausted here. Once it starts to come down, you know, then we're off on a downtrend again.